Good afternoon, and thank you for joining us for today's webinar on cash balance plans. I am Steve Renner, a principal with our retirement plan services team, and I'll be moderating today's presentation. Before we get started, a few housekeeping items to cover. If you have any questions during today's presentation, you may enter them into the chat box. We will try our best to answer as many questions as we can, either during or at the conclusion of today's presentation. To be respectful of your time, if we're unable to get to all the questions, we will review and we'll send out answers via email as soon as we can. Today's presenter is Mike Spickard, Chief Actuary at Summit Retirement Plan Consultants, LLC. Mike is an enrolled actuary with over 30 years of experience with qualified retirement plans. Mike's prior experience includes the Director of DB Plan Services for Charles Schwab, Manager of Retirement Plans for BF Goodrich, as well as being the founder and CEO of Summit Retirement Plan Services. Mike, welcome, and looking forward to your presentation today.
Great, thank you, Steve. I appreciate being a partner with Ray Pension Services and having the opportunity to make this presentation to valued partners of your firm. First of all, I want to make sure that everyone can see my screen. I'm in share mode right now, so hopefully you can see what I'm looking at, because that's the material that we'll be going through. I don't like to merely read the slides, though the content is out there to sort of keep us on track, but to the extent that people have questions, they can submit those as we go along, or you can ask them at the end. So why don't we begin? We're going to talk today about cash balance plans. So what is a cash balance plan? Well, it's a variation. It's another type of a retirement plan. The big difference with this is that there's really no hard dollar annual deduction limits. And the reason is because it's actually a defined benefit plan in the eyes of the IRS, and therefore subject to those rules. Now, what is a defined benefit plan? Well, back in the day, our fathers and grandfathers used to get a monthly benefit when they retired. That was called their monthly pension, their monthly annuity, and a cash balance plan uses those same rules, but it actually defines a lump sum up front, and then you're allowed to get a monthly annuity on the back end if you want to, or you can just take out your cash balance account, which is your lump sum. So in any event, the name says it all. Cash balance plan, it's a lump sum driven plan. It's easier to understand, fund, and administer. And it works very well for business owners who want to contribute more than what a defined contribution 401k profit sharing plan will allow. Now, because it has the rules of defined benefit plans applying to it, cash balance plans do have annual minimum funding requirements. And we'll talk a little bit about some of the flexibility that's associated with those funding requirements. Similarly, top-heavy contribution rules apply if key employees have more than 60% of the total benefits under the plan. The plan is required, unless it's a professional service corporation, to pay insurance coverage to the PBGC, and this comes to about $90 per participant. So there is an extra, in addition to administration fees, there's an extra insurance fee that has to be paid by the plan sponsor on top of that. Furthermore, there are minimum participation rules that don't apply to a profit sharing plan. A lot of people don't realize this, but you can pick and choose who you want to benefit under a profit sharing plan. And in some respects, you can do that under a cash balance plan, but we must satisfy these minimum participation rules of the lesser of 40% or 50 employees benefiting under the program. So if you have a 10-person company, we have to benefit at least 4 people in the cash balance plan if we're going to have one. Joint survivor annuity options must be offered. I mentioned that the plan is lump sum driven, but we do have to offer an annuity, and there has to be spousal consent obtained before that cash balance account can be paid out as a lump sum. Finally, in some instances, the plan might have an additional valuation reporting requirement for the income statement and balance sheet of the client if they're subject to GAAP reporting. So why might a company, a business owner, establish a cash balance plan now? Well, primarily it's to reduce their tax bill on their business, assuming they've got profits that they're trying to shelter. It's also an efficient way to take cash out of the business and protect it from potential creditors. These plans are more attractive at this point because of the liberalization of the funding rules, the very high funding limits that I mentioned earlier. There are no hard dollar limits, and there's even bonus rules that apply to these types of plans if there's a profit sharing plan that's alongside it. So cash balance plans at this point happen to be the most prominent in terms of the fastest growing plan type in the United States. I notice every year, late fall, the Wall Street Journal, Fortune magazine, Forbes comes out with an article. It might be time to look at a cash balance plan if you're a small business owner. And they'll quote some of the folks from our industry touting the great benefits of a cash balance plan. With defined benefit plans back in the old days, there wasn't as much variation in the benefit levels between participants. With the cash balance plan, we have much more flexibility, which makes it attractive for partnerships and professionals because one of the partners, one of the business owners may not even want to participate or might want to participate at a lower level. These plans can accommodate a tiered benefit structure or exclude some people altogether if they don't wish to contribute or be part of the arrangement in a cash balance plan. And then finally, a cash balance plan can be used to fund a buy-sell arrangement, where if there's some agreement between two owners, an older owner and a younger owner, you set up a cash balance plan, you make tax-deductible contributions toward that, and that asset for the selling shareholder becomes part of their take, if you will, with the buying shareholder. Now, people have shied away from cash balance plans for various reasons. No offense to our friends at Ray and Associates, but CPAs seem to be the primary source of killing the idea of adopting a cash balance plan. Ray and Associates seems to be more progressive and more aware of the various benefits and dispelling some of the myths about cash balance plans. So I'm happy to be working with them. But let's talk about some of those myths, because sometimes those make their way into these articles at the end of the year that I talked about. They'll state that the plan has to be in place for at least 3 to 5 years. And this is to meet a permanency requirement in the Internal Revenue Code, which is undefined. And therefore, someone has come up with a standard of at least 3 to 5 years. That is not the case. I've terminated plans after 1 or 2 years if business conditions necessitate. Similarly, cash balance plans can be flexible based on the business conditions of the plan sponsor. And the plan can be amended from time to time, frozen, and terminated altogether if the business conditions of the plan sponsor warrant it. For a long time, our community wondered, what does the IRS really think about cash balance plans? And about 12, 13 years ago, they finally came up with regulations that officially recognize cash balance plans and sanction them. So right now, the IRS understands that that train has left the station. Cash balance plans are very popular. They need to properly regulate them, and they are. Cash balance plans are not risky if they're properly managed. So it's very important that everyone is working in concert between the client, the investment advisor, the actuary, the TPA, and it really minimizes the risk associated with maintaining a cash balance plan. This fifth bullet point, that they require funding every year, is one that often keeps a plan sponsor away, and sometimes it should keep them away. If they have very volatile business conditions and they're making money one year, but they may lose a lot of money the next, they may not be a great candidate. But if a business owner is usually pretty profitable and likes the idea of setting up a cash balance plan, but is a little bit hesitant because they don't want to be chained to this, well, they can be told, and it's true, that the funding levels can vary significantly or even be eliminated in certain years if the plan's frozen in time or the plan is amended to reduce benefit levels. So there's a lot of tools in the actuarial toolbox to modify the funding requirements each year if the business conditions necessitate. There's another myth that you're going to have to put in a lot of money, and this was more so for the old school defined benefit plans, where you did have to put away a lot of money, especially for older employees. With a cash balance plan, we can significantly moderate the employee costs by putting up a profit sharing plan contribution instead of a large cash balance contribution. And I'll talk about that dynamic here in a few moments. The second to last bullet point, this is one that plan sponsors definitely need to be made aware of and somewhat warned against. We don't want them looking at this like it's a jumbo profit sharing plan. I can put money in when I feel like it, or if I don't feel like it, I don't have to. They've got a profit sharing plan for that, lower limits that they're going to have to live with, but a cash balance plan is very powerful, very effective, and it's significantly increasing tax deductions, but it has to be something that the plan sponsor is committed to, with reasonable caveats if their business conditions warrant changes to be made on a year-to-year or even every other year basis. Finally, they're too costly to administer. Well, I suppose in some situations they might be, and there does have to be a cost-benefit analysis done where you look at the amount of the tax savings that is being realized versus the cost of the plan, both on the administrative side, I mentioned PBGC insurance, and then how much is having to be contributed for the employees to make everything work. So cash balance plans aren't for everyone. They have to be properly designed and they have to be properly maintained. And this is where I mentioned earlier, good communication has to be fostered and maintained between all of the professionals who are helping to service the plan. And thus a plan sponsor who fails to trust their consultants, doesn't really understand how the plan works and doesn't want to, has volatile business conditions, and generally is undisciplined with their cash flow, probably not a good fit for this type of a plan. I mentioned PBGC premiums again because sometimes that can hit plan sponsors out of left field. What's this $1,800 fee that I have to pay now? So it's something that's definitely a downside, but there are some upsides as well where you get even higher deduction limits if the plan is covered by the government's pension insurance program. I already talked about that second to the last bullet point. And the last bullet point is very important because if a plan sponsor has a lot of different, if their business is changing every year in terms of who they've got on the payroll, what business they're in, the cash flow from the business, these dramatic changes from year to year or even every couple of years generally don't bode well for a cash balance plan. So conversely, a cash balance plan is a good fit when you do have a relatively stable situation on the profit side of the ledger. And now we're starting to get into some of the points that really make a cash balance plan work. And this is where there's age disparity between the owners or the shareholder class that's being covered under the cash balance plan and the rest of the staff. There doesn't have to be huge disparity, and there doesn't have to be disparity for every single employee. It's just on average, there should be some disparity, and I'm going to show you why that's important here in a few moments. I mentioned that third bullet point about already maxing out their 401k plan because it's very unusual for us to set up a cash balance plan if a plan sponsor's never funded a 401k plan, never funded a safe harbor contribution or profit sharing contribution. Let them get the training wheels on first for a year or two of having a 401k plan before they go to that additional level of complexity with a cash balance plan. They need to be able to commit to funding each year, even if it's reasonable to think that if things go south, yeah, I made this commitment to fund when I set up the plan. I'm having troubles. I need to modify this. Yeah, we can work with a plan sponsor like that. And the IRS understands that. Business conditions are going to change. Therefore, there are rules and techniques in place that allow business owners to make changes to the plan so that it still works. I mean, at the end of the day, the IRS is all about encouraging retirement plan formation and reasonable and meaningful contributions covering a broad spectrum of employees. And so even if a client that you have doesn't match every single bullet point here, it still might work. We give a free look. We do free illustrations if we're provided with census information and maybe some plan details about their 401k plan. And we can determine whether the cost benefit of adopting a cash balance plan is really there. All right, when is it not a good fit? I think I touched on most of these bullet points, so I won't talk about that. That third one's important. Sometimes you have a 32-year-old business owner and maybe it's a doctor who's bought out somebody else's practice, and but all the staff is still there. And so it's these employees in their 50s and early 60s, probably not going to work well for that particular situation. I already talked about not having a 401k plan. They also have to understand, the business owner does, that there is some investment risk that they are taking on when it comes to a cash balance plan, because we are providing a benefit to employees and we are also guaranteeing the rate of return that those employees are going to receive in the cash balance plan. Now that's why generally you're setting a very low, reasonable rate of maybe 3 to 4%. And the investments are going to be managed in a fashion that really seeks to track what is being guaranteed or credited in the cash balance plan. So we'll talk a little bit more about that later. If you do have a client and the owners don't really get along, it might be a prosperous business, but they don't agree on much. They're always fighting about things. This is not something you want them fighting over. And of course, we're having this session here to better educate advisors about cash balance plan. Maybe not to make you experts, but at least give you a better idea of how they work. And we're going to talk in more detail about that right now. So this is all, the next several slides are going to be talking about the plan design. So the IRS actually does allow a greater percent of pay allocation for older participants. They allow discrimination up to a certain level. And that discrimination can be enhanced if the business owner is very old and highly paid, and most of the staff is younger and lower paid. And that's by utilizing age-based testing. The IRS allows you to satisfy non-discrimination on two different bases. One is just a pure contribution basis. You look at, is everybody getting the same percentage of pay, 5% of pay, 3% of pay? And the IRS will allow a kicker in there for employees making above the Social Security taxable wage base. The other way is age-based testing, where instead of looking at the annual contribution that's given to each participant, we take the annual contribution and we look at what would that buy at retirement in terms of an annual annuity based on the compensation that someone is earning today. And I'll give you an example of what that looks like, but it's going to direct a greater portion of the overall contributions to your older, higher paid employees than just the straight up safe harbor contribution testing. So this is a great example. It's kind of maybe an extreme example because not every business has a 57-year-old making $250,000 and a 22-year-old alongside that person making $30,000. But it's really, in some respects, just intended to show you how fantastic these testing results can work when you're testing using age-based testing. So this 22-year-old who gets a $1,500 allocation, that's 5% of pay in the profit sharing plan, that equates to a $6,000 a year annuity at age 65. So they're getting a 20% of pay, hypothetical benefit. Nothing has to be guaranteed here. This is just all for testing purposes. On the other hand, this 57-year-old employee gets a $200,000 allocation, 80% of pay. So if we just looked at it on a contribution basis, one person's getting 5% of pay, one's getting 80% of pay. That fails just on the face of it, the non-discrimination standards. But when we use age-based testing, this 57-year-old's only getting an 8% of pay annuity benefit. Now, why is there such a huge disparity here? Well, number one, that 22-year-old has 35 more years to accumulate interest on their $1,500 profit sharing allocation than does the 57-year-old. Furthermore, profit sharing allocations are allowed to be increased, hypothetically, for testing purposes, at an 8.5% annual rate, whereas cash balance allocations are only increased by your interest crediting rate under the cash balance plan, typically 3 to 4%. So the power of compounding really kicks in for younger employees with their profit sharing allocations, not so much on the cash balance side. So this is legal and IRS approved, and we do this all day long. And that actually is what was happening in old school defined benefit plans. You have a 22-year-old who's making $40,000. You have a 60-year-old who's making $40,000. Each of them is promised some annuity benefit, and that 60-year-old's annuity benefit is going to be about 5 to 8 times more costly than their 22-year-old counterpart. So when we're designing the plan, thinking about all the things we've already talked about, how age-based testing works, the fact that we can have tiered benefit structures, we can focus on targeted groups because not everyone has to be eligible for the cash balance plan, so long as we cover at least 40% of the eligible employees. So I just set up a plan for a 5-person company. The husband and wife are both on the payroll. All we had to do was cover the husband and the wife. We didn't have to cover anyone else in the cash balance plan. We put the other employees getting their benefit in the 401k profit sharing plan. 99% of our plans are set up this way. We call them combo plans. So these employees were getting all of their required contributions in the 401k plan through the profit sharing sleeve that's inside of the 401k plan. And the owners were the only ones participating in the cash balance plan. So generally, you're going to be deciding if the plan is going to go through based on what the owner or the key employees want to do. And they don't all have to be the same. We generally see in larger surgeon groups or professional groups a much higher contribution structure for older participants. And you might say, well, how do you justify that? Well, you might have your senior physicians and your junior physicians and different contribution levels in the cash balance plan, depending upon the category that those owners fit into. And furthermore, they don't have to be in the plan at all. Junior physicians can be excluded altogether and it may only cover your senior physicians, just as long as we satisfy the annual non-discrimination testing. The allocation formula, when you're going into it, it's got to be considered permanent. And I put that in quotes because it can be amended from time to time. And if business conditions necessitate it, it can be amended every single year. Generally, we don't advise that, but it's still possible to do so. That final bullet point, we don't do this all that much, but you can actually create a plan that provides benefits to a wider group of employees, but then offsets those benefits by what is being provided in the profit sharing plan. Now, there's special rules associated with that. It gets very complicated, not to mention you're having to tell employees, well, yeah, you're in this plan, but we're taking away whatever benefit you might have received because we're crediting what we contribute in the profit sharing plan. So we don't use it that much, and it's usually only for larger plans where we have to cover at least 30 people in the cash balance plan. So how is the annual funding requirement determined in a cash balance plan? Well, the first item is the bulk of the annual funding requirement, and that is what were the sum of the cash balance credits that were awarded for the year. So if the business owner is getting $200,000 as the allocation in the cash balance plan, okay, it's going to be $200,000 plus that second item. Okay, how did the plan assets do? Was there a big loss in the investment account this year? If so, then some of that has to be paid for so that over the next 12, 15 years, the plan would be able to pay out all benefits when they are due. So it's not like if a plan loses, it's $1 million plan and it loses 10% instead of gaining 3%, that $130,000 is going to have to be funded in 1 year. No, the IRS allows you to smooth that out and only pay down a little bit of that shortfall in any given year, because the expectation is it's going to swing back and that extra little funding requirement is going to go away, and you're back to largely what the sum of the annual allocations are. Now, because it's a defined benefit plan, the rules are kind of funny in that there's going to be a minimum required, and then there's going to be a maximum allowed or a maximum deductible. These are determined based on taking the cash balance allocations, converting them to annuities, and then discounting them back to today using IRS published rates. And there's two sets of rates for the minimum contribution and the maximum contribution. So what it does is it creates a range of contributions that allows a tremendous amount of flexibility for plan sponsors who in any given year, I know I was contributing $200,000 the last couple of years, but if I could get away with it, I'd really only contribute $140,000 this year. Chances are in the third year of a plan, they'd be allowed to do that, even though they're still getting a $200,000 cash balance credit. Furthermore, the maximum is going to get larger and larger because the IRS allows plan sponsors to overfund a cash balance plan. And this overfunding can be up to 150% of the difference between the liabilities and the plan's asset value. So let's consider even a frozen plan where there's $1 million of assets, $1 million of cash balance accounts for the participants. Hopefully 80, 90% of that's going to the business owner. And the business owner would like to make a contribution to the plan. The plan's frozen, nobody's earning benefits in it, but all of a sudden they've got an unexpected profit. And they could put in $500,000 into the cash balance plan as a deductible contribution. Now, a good question would be, who is that money going to go to? Because now the plan is overfunded. Well, those amounts can go toward future allocations. So the expectation would be, even though it may not have happened yet, that the plan sponsor is going to unfreeze the plan, start earning allocations in the plan, and now they've got assets in the plan that have already funded those allocations. So because of the actuarial rules that determine a minimum and maximum contribution, The funding levels can vary quite significantly from one year to the next if the plan sponsor wants to do that. We generally encourage relative stability in the amount of the contribution so that the plan sponsor isn't hit by any surprises. It's just a better way of doing it. There are limitations in terms of how much can be put into the plan. I know I've talked up these programs as if the sky's the limit, but there is a limit, and it's not the sky. We can't fund any more than what is necessary. Actually, the benefit that the business owner receives cannot be more than the amount necessary to fund an annuity. Here's where those defined benefit rules come into play, of $265,000 per year, payable at age 62. All right, Mike, tell me this in language I can understand. All right, it's a lump sum of about 3.4 million payable at age 62. So if a business owner is 55, they've got 7 years to go, they can put away a couple $100,000, maybe $220,000 a year to fund toward that $3.4 million limit that can be paid out to them at age 62. The last bullet point's a very important feature, and that is if a plan sponsor hasn't contributed the maximum, maybe they started it and said, I only want to put in $100,000 a year for the first 5 years. And then things really start to take off with their business, and they're like, can I significantly increase that? Yeah, you can go up to $300,000-400,000 and play catch up for all the years you didn't maximally fund the plan. You can now fund it in the later years and catch up with those benefit levels. So at this point, and these amounts change every year with IRS cost of living adjustments, these are the maximum annual accruals that a business owner can receive in a cash balance plan. Now, notice I didn't say this is how much can be contributed, because that's a different story. There's an actuarial computation that is utilized to determine how much can be contributed. So we talked earlier about what drives that contribution. So let's look at that 62-year-old. They can put away, they can receive a benefit of $340,000 a year, but they could potentially fund a contribution in the first year of 150% of that because of those special maximum funding rules. 150% of 340,000 would be 510,000. So we've had ample examples where we've had business owners who are able to contribute in the first year $400,000 or $500,000 a year. And this works very well, especially for sole proprietorships and husband and wife arrangements. And it can work in other examples as well. All cash balance plans must use a 3-year cliff vesting schedule. They, of course, allow lump sums to be paid, but benefits can be held until a later date. And so this sometimes is important where a business owner sets it up for him and his junior partner, but he's not sure if that junior partner, is, they both live separate lives. They don't know what's going on. And all of a sudden that 5% owner leaves and goes into business against him. Well, he doesn't want him to take his cash balance account with him, so you can actually hold on to those monies until the plan's either terminated or 5 years after the employee leaves, or until the plan, or until everyone turns 65. Just a little tidbit on that there. We do have to offer annuity benefits and obtain spousal consent to pay out those lump sums. And now these programs can offer in-service withdrawal contributions at age 59 and a half, just like the 401ks and IRAs. Now this is important because I talked earlier about the fact that the plans have to be somewhat conservatively managed in that we're trying to target that interest crediting rate of 3, 4, maybe 5%. Some business owners, man, they're just itching to invest that money in something more risky and something that they think is going to achieve them a higher rate of return. So maybe they fund, they're 55, they fund a couple $100,000 a year. Now they've got $1 million in the cash balance plan. They're not ready to shut it down, but boy, they'd like to put that money in their 401k plan or their IRA. and manage it a different way, they can do that. They can take all their money out of the cash balance plan and continue to fund the cash balance plan according to the same rules and same benefit levels in future years. That final bullet point speaks for itself. All right, so I'm going to rest my voice for about 15 seconds here and maybe take a look at any questions we might have received along the way. Steve, it looks like everybody's
no
trucking along.
Yeah, no questions thus far, but two quick updates. The Fed did decide to increase rates by 1/4%, and the Guardians are up 4-0, headed to the bottom of the fourth in Cleveland. So
okay,
updates there to let you rest your voice for a second and carry on.
Thanks, Steve.
Yep.
The latter was much more important than the former, I think.
Exactly. Got to get back to 500.
Yeah. Okay. All right. Let's talk now about these combo plans, what they might look like. So here's an example. Any type of business might have partners, directors, managers, and you can vary their contributions in a very significant way. The key to this is there has to be two plans, not only a cash balance plan, but a 401k profit sharing plan. Alongside that, we designed it this way. This is not atypical. And from a discrimination testing perspective, it works out. So this is common, the common multi-plan arrangement. You cover everybody in the 401k plan, in the profit sharing plan, non-shareholders and managers receiving contributions. Then in the cash balance plan are shareholders and non-managers, and then all other employees, rather than getting benefits in the cash balance plan at all, are only receiving profit sharing benefits, and we're testing them all together for non-discrimination. So let's look at a real live case study with real numbers. This is a company that has 2 owners, 7 employees, currently offering a safe harbor 401k plan plus a 5% profit sharing contribution. They're ready to go to the next level. They've been maximally funding their 401k plan. We come in and put a cash balance plan on top of that, but we only have the partners and admin personnel eligible for the cash balance plan. So this is for purposes of meeting that 40% requirement. So we've got, I think 9, yeah, we got 9 employees here. 40% is 3.6. You have to round up. So we're covering 2 other employees in the cash balance plan. We haven't changed our profit sharing contributions at all for the staff. Now we had to dial them back somewhat for our business owners, because if a plan's not covered by PBGC insurance and professional service corporations, so doctors, engineering consultants, lawyers, CPAs, they're not covered by PBGC insurance unless they have more than 25 employees. This one does not, so it's subject to a somewhat stricter multi-plan deduction limit. So we have to dial back some of the profit sharing contribution for the doctors in exchange for being able to maximally fund their cash balance account. So in this particular example, the partners were only getting $147,000 before. They now are getting nearly $600,000, but staff costs did not change materially. The Pension Protection Act of 2006, which has now been around for 17 years, really turbocharged cash balance plans and made this type of arrangement possible. So, and I've already talked earlier about they could put even more than that $570,000 due to that 150% funding allowance. So how are these plans invested? Well, we don't set up individual accounts for each participant in these types of programs. There's one pooled investment account. There's not any, other than that, there's no special rules in terms of what the cash balance plan assets can be invested in. They should be prudent and easily valued, because once a year we have to report to the IRS what's in the plan, and we have to report that at fair value. And we have to use those values to determine the annual funding requirement. So if a plan has bought an interest in a privately held company, that's going to be difficult to value. And it may also not be prudent because there are other people generally in these plans, even though the business owner has the bulk of the benefits and therefore has a claim on a bulk of the assets. Nevertheless, it shouldn't be managed as if the business owner was directing this like their personal account. That being said, if it's a young business owner or business owners, they could invest maybe more aggressively because they've got more years to have things balance out than what an older business owner would have, where if the plan's only going to be set up for a couple of years, 3 years, and then the first year out of the gate, they lose 25%, that's going to create some issues. So generally we advise, I know Steve advises that the investments should be targeting whatever the annual interest crediting rate is under the plan with some limited volatility, plus or minus 2% each year. And then understanding that if they don't hit that number, it's not the end of the world. There's ways to deal with that. I almost hate to talk about this slide because it's not something that we do right now, but it's something that's out there. There are competitors of ours that are marketing these market-based interest crediting determinations on cash balance accounts. This is where the interest that's credited on the cash balance account is equal to or significantly tied to the performance of the actual cash balance investments. And it sounds great, and I would love to do it, but it makes testing much more difficult because you have to use that actual rate of return now in your age-based testing. Well, if 1 year I'm doing my age-based testing using a 3% rate, and the next year it's a 13% rate, well, that's going to make life miserable for the plan sponsor because they're going to have to put in a lot more money for their rank and file participants. Furthermore, there is this preservation of capital rule, which means that even if your plan loses money every year, you still have to guarantee for the employees in the cash balance plan a payout of not less than the sum of all of the cash balance credits that they have earned. So you'll find that always in the small print of the people that are touting these types of plans. So, and then if the assets are volatile, then that's going to create volatile funding results. So cash balance plans are really, they're a tax deduction maximization vehicle. They shouldn't be looked at as I'm going to grow this significantly on the investment side. That really, it means they're taking on more risk and the attendant problems that go along with that, particularly if there's investment losses. Everybody likes gains, of course, but if there's investment losses and then somebody has to get paid out, they're downsizing the business, now the plan's underfunded, it can create significant problems if we're trying to cash out, especially former owners or highly compensated employees. So I've already addressed some of these frequently asked questions. If there's a valid business reason, a plan can be frozen. Of course, if those business conditions change and things get better, they can unfreeze the plan and go back to where they were, or even institute a new benefit level. What happens if the business owner is tired of the plan, they're ready to shut it down, and there's not enough money in the plan to cover all of the liabilities? Well, at the end of the day, the business is on the hook for that difference. There's two ways they can satisfy it. They can fund it up, make a contribution, or in probably 2/3 of the cases, the business owner pays everybody else out and just takes what's left. They can waive off their benefits down to the level of whatever assets are left over after everyone else gets paid out. Can a cash balance plan invest in real estate? I need to put no in as the first No, they can't invest in any asset that can be reasonably valued, but it can't be real estate that the business owner has a direct tie to. So they can't, the vacation home that the business owner uses can't be bought with plan assets. There has to be a very arm's length transaction. If a business owner's already had a DB plan or a cash balance plan, they can still set up a new one. We have to monitor, they can't set up a new one and ignore what they were paid out under the prior plan. We have to take into account what they received under that prior plan, but it can still work. We set up a couple this last year where the business owners terminated in 2012, 2014. Now the IRS limits are much higher. They can put away another $300,000-$400,000. They're going to do that, have the plan open for 2 years, probably shut it down again. So cash balance plans are a very powerful and effective tax deferral tool, though I hope I've emphasized enough that they have to be thoughtfully designed and well maintained with all of the professionals working in concert with one another. And we want cash balance plans to really speak for themselves after careful consideration is given, and really not try to sell somebody on the idea of a cash balance plan who really isn't comfortable with it or really doesn't fit a good profile for it. And cash balance plans are not forever. There's a lot of flexibility. I tell plan sponsors, this is your plan. You're deciding whether you want to move forward with it, at what benefit level. You decide each year if it's still working for you, whether you want to increase that, decrease that, freeze it all together. And then you also decide when you're ready to wash your hands of this and move on and terminate it. So we have to follow IRS and PBGC guidelines, but there is a lot of flexibility within those guidelines to meet the needs of the plan sponsor. So that's really about all I had today. Any last minute questions here?
There's nothing in the chat, Mike, but I'll lob one out to you. Can you speak to utilizing life insurance policies in a cash balance plan?
Well, I'm not expert in that because we don't do it.
And I guess the pitfalls that you see, maybe.
Well, the rules are, well, frankly, the rules are somewhat dark and opaque. And because they're so seldomly used, I think that there is some room for abuse, if you will, or at least blissful ignorance. And these are tax qualified plans, and you can have an insured benefit inside of the plan, but at the end of the day, it's taxable still to the beneficiary. Right. So whereas my understanding, if you're buying life insurance outside the plan, that's not taxable to the beneficiaries. So from that perspective, I don't quite understand the value proposition of having life insurance inside a qualified plan. There are different funding rules depending upon if you're using an old school funding rule called split dollar funding, where you're allowed to essentially fund the benefit, the cost of the benefit, and the cost of the insurance, but you have to separately track what those annual costs are and then kind of the accumulated costs towards those. So it gets pretty complex. And I mean, let's face it, there's a lot of commissions paid on those insurance products that go inside of a retirement plan. So I generally don't see your, what I'll call higher tier investment advisors and financial planners, because if it works, if the whole concept works well with a cash balance plan, it should also work well inside of a 401k or profit sharing plan in terms of the underlying fundamentals associated with having life insurance inside of a qualified retirement plan. And I just haven't seen it for decades, where it was a commonly utilized practice. Now, that being said, I don't want to throw mud at everybody or anybody that does it. I'm sure there's a way to do it efficiently, or as efficiently as possible, where in certain circumstances it might work. And because it does bring into play estate taxation, inheritance issues, and all of that. So, there might be circumstances where when you put all those rules together, this might be the best way to do it.
Good answer. In my view, yes, it's making an already complex plan more complex. Just adding another layer to it.
Yeah, that's a good way of stating it.
Yeah. I know we've recently worked on a few cases where there's like physician assistants, or maybe a higher paid junior level doc. I guess, can you speak to maybe the benefit of having those individuals in the mix because they're HCEs, and what that might look like in a smaller 10 to 12 person group? I know that we still have to give them the top heavy minimum, but maybe give a little information on how that works and how you can utilize what you're providing to the HCE as a top heavy minimum to kind of offset what has to go to the staff.
Yeah, so I think what you're asking is there's sometimes you want to include a younger, higher paid individual, but not benefit them at a significant level.
Right.
Because if they're benefited at a lower level, because I only presented a simplified form of the testing, just so we didn't get too far into the weeds. But the testing, the age-based testing, also is including an average testing component of the highly compensated group versus the non-highly compensated group. So we want to have sometimes younger, higher paid individuals in the mix, but not getting a large contribution, so that they bring down the average benefit rates of our higher paid group versus the average of our lower paid group. Is that what you were thinking about there, Steve?
Yep, absolutely. I feel like we're running into more and more of those situations, so I just kind of wanted to talk about that a little bit.
Yeah, definitely. There's, these business owners that are trying to bring in a younger class to transition the business over to, and yeah, some of them have waited maybe waited too long to make that happen. So
yeah. Well, I don't see any questions in the chat here, so I wanted to thank you, Mike, for sharing your insights. You and I can talk about some of these scenarios for hours, but we were allotted an hour today, so to be respectful of everybody's time, if there's no additional questions, I'll just, once again, thanks for all the information you presented today. It's very helpful for the advisors we work with, and even our team here at Ray and Associates. So I really appreciate it.
Well, thanks for the opportunity, Steve. I love to talk about these things, and I hope I didn't bore people too much on a very warm, sunny afternoon.
Yep.
All right, sir.
Yep.
Thank you, everyone.
Thank you very much. We'll talk soon.
Okay. Goodbye.
Bye.